Welcome to video 4 of part 3 of the EA Tax Training Enrolled Agent Exam Preparation course. Tom here, back with you to discuss the tax filing process. This is the final video in part 3 and in the entire course. It's also the shortest video. Congratulations on making it this far, and let's see what we are going to learn today. We are going to talk first about tax return accuracy. Then we will talk about record maintenance, and then we will spend most of our time today talking about electronic filing. Our free resources, the first two, are the same that you've seen in every video in part 3. And then the last two is Form 8879 and Form 8453 and their instructions. The good news is they are both short forms and short instructions. So go ahead and take a look at those forms, read over those instructions, and it will help you on the exam. So let's talk first about tax return accuracy and reliance on software. The taxpayer is always going to be responsible for the amounts reported on their tax return, regardless of the method of preparation. And notice who is responsible? The taxpayer. So obviously, as a tax return preparer, you want to do a good job for your clients. Ultimately, however, as far as the IRS is concerned, the taxpayer is the one that's responsible for the amounts that are shown on their tax return. Now, from a civil liability standpoint, you as the preparer could be responsible if you do something wrong, if you make a mistake. In other words, the client could sue you if you make a mistake. But the IRS considers the taxpayer ultimately responsible for what is on their tax return. As far as using tax software goes, of course you're going to use it, and it is a very valuable tool. It's great, but it should not be exclusively relied upon to be accurate. You cannot just assume that if you put the numbers in, that it's automatically going to spit out on the other side the correct tax return. You have to know what you're doing. That's why you can't have someone who doesn't understand taxes doing a tax return. You can't just say, well, just input the data into the right spot and then you'll automatically have a correct tax return. That'd be great if it always worked that way, but it doesn't. First of all, sometimes the software can make a mistake, can be programmed wrong, or more often what happens is the person who's entering the data makes some mistake. They either put an amount in wrong, they put it in the wrong place, they put it in two places instead of just one place, and it duplicates an entry, something like that. So you have to be very careful that what comes out on the tax return is what is accurate in what you actually want to show there. And there have been tax court cases where the taxpayers have tried to say, hey, we put it into the software and this is what the software came up with. I was relying on the software to be accurate. And the tax court has said that that is not a valid defense. It's the software's fault is not going to work with the IRS or with the courts. And of course, anytime you're talking about computers, you've got this concept of GIGO, garbage in, garbage out. If you put the wrong thing in, doesn't matter how well the software works, you're going to get the wrong answer on the other side. Having said all of that, mistakes do, of course, happen. Sometimes the taxpayer or you as a preparer will make an error. A lot of times, errors are made due to duplicate entries. So the software is great and it will try to pick up anywhere it can information to use in other parts of the software. And sometimes the tax preparer doesn't realize that, and then they will enter that same information again and it will get double counted. So some of the common places that happens is with HSA contributions, state taxes, especially state income taxes, sometimes also real estate taxes, and then on Schedule C income, specifically from 1099s. So for example, if you have someone that makes HSA, health savings account contributions through their employer through payroll deduction, and or the employer themselves making contributions on the employee's behalf, that will show up on the W-2. So when you go into the tax software, it will frequently just ask for all the amounts on the W-2. And so if you put in there all the amounts, you're going to put in there the HSA contributions. And then in a different part of the software, there will be a separate screen for HSA contributions. And you have to know that the software has already picked it up from the W-2. If you go ahead and you enter that amount again on that separate screen, it is likely to count it twice. So you have to be careful about that. The same thing can happen, for instance, with real estate taxes. You get a 1098 and it shows mortgage interest, but there could also be on that 1098 real estate taxes. And so if you then enter the real estate taxes there when you enter the 1098 and you enter them again on a separate screen for taxes, you're going to double count it. And then 1099s, Schedule C, you're going to put all of the revenue from the business on Schedule C. You're also going to get 1099s. Well, it's very likely that the taxpayer's records, where you're getting the information for the Schedule C income, they probably already include all of the income from all of the 1099s. So if you then enter the 1099 separately, you're going to be double counting that income. So you need to be careful about what's included where and where it has already been entered. But in any case, these, and this is just examples, it can happen with lots of different numbers on the tax return. It's easy to make a mistake. And sometimes it's even easier because you have the software, because the software is trying to be efficient and to save you time and steps. You don't even realize it's doing that, and then you double enter something. So what happens if you make a mistake? Well, if you've already filed and you notice the error before the IRS says anything about it, then you need to file an amended return, as we have talked about previously. If the IRS notices the error, then they will send you a notice. And likely what they will do is say, hey, we found this mistake. We've adjusted your return. And then either you owe more money or you get more of a refund. Sometimes, though, they may not know exactly how the error affects everything in your return, and so they may direct you to take other steps up to and including amending the tax return. So you're just going to see what the notice says and respond accordingly. Next topic is record maintenance. Specifically, we'll talk about here record retention. So, of course, when you're preparing the tax return, you are going to be requesting and receiving a lot of documentation from the client. We've talked about this in previous videos. So, you may be getting all of these things that we've talked about: prior year tax returns, W-2s, internal accounting records, bank statements, expense receipts, etc., and so forth. So, you will want to keep all of these documents or a scanned copy, could be a paper copy as well. Usually these days we're dealing with scanned electronic copies, a lot easier to keep that. And then you're also going to want to keep notes from client meetings and what they said. You want to keep any emails that are applicable to the tax return. One thing I like to do is if you have a meeting with a client, you take notes, is to then summarize that in an email to the client and say, here are all the things that we talked about in the meeting. And then you can just send that to verify with the client. And if they object to anything, or if they say, no, this is wrong, then you can have that email chain that says that. Now, having said all of that, you do want to be careful with a couple of things with email. If there's any legally sensitive items, like there could be a crime involved, something like that, then do not put that in email. They're going to want to get an attorney and discuss that issue with the attorney, but you wouldn't want to put any type of sensitive issues like that in email. And then also, if there's any sensitive information in the email, you would always want to send that encrypted in some way, which we'll talk a little bit more about that in a little while. But in any case, if you do have any emails, so the client sent you an email with some information, you'd want to get an electronic copy of that and keep that with your records. And again, paper or electronic copies are acceptable, a lot easier to do it electronically. And there are various software programs out there where you can store all of this information for each of your clients. How long should you keep records? Well, the easy answer is that records have to be kept for as long as the statute of limitations is in effect for that return. Usually that's going to be 3 years from the later of when the return was filed or due. Remember, that's the statute of limitations that the IRS has to go back and audit your return. But there are those few cases where it could be longer than the 3 years. But the 3 years is a general rule. For property transactions, as we talked about when discussing assets and depreciation and such, property records may have to be kept for a long time. So you have to keep the records to prove your basis and depreciation, etc., until the statute of limitations has expired for the year that the property was sold or otherwise disposed of. So this is the example. You could have a building, business buys a building, they hold it for 20 years before selling it. You need to keep the original closing statement and all the documents to prove how much you paid for it and how much depreciation is until the statute of limitations has expired for the year that they dispose of it. So it could be 23, 24 years, could be 30 years, it could be many decades that you keep those type of documents. For payroll and employment tax records, they have a separate rule. They should be maintained for at least 4 years after filing the fourth quarter of a particular year. And payroll records is going to include the names, addresses, and all the identifying information for all employees, all wages that were paid, copies of W-2s, W-4s, etc., all the things you see there on your screen. So for payroll records, you will want to remember for the exam, it's 4 years after filing the fourth quarter of that particular year. So let's talk about data security. Protecting taxpayer data is required by law, and it is enforced by the FTC, the Federal Trade Commission. As we have said before, tax preparers must have, they're required to have a written information security plan, or WISP, and it should do all of these things. It should designate someone to coordinate the program, identify and assess all the risks and what the current plan is and the safeguards and whether or not they are effective, design and implement safeguards, and then monitor those and test them to make sure that they are working properly. Select service providers that can maintain appropriate safeguards. So whether you're selecting software or whether you are working with other professionals, you want to make sure that they also have appropriate safeguards for the data. And then, of course, you're always going to evaluate and adjust as necessary. So some basic security steps. As we discussed before, you will want to learn to recognize phishing emails and avoid them and never click on a suspicious link. You would like to install anti-malware and antivirus software. You want to use strong passwords of 8 characters or more and use different passwords for different accounts and different sites. So don't keep using the same password everywhere, because if it gets stolen in one place, then they'll be able to use it in lots of different sites for you, and that would be a bad idea. Encrypt all sensitive files and emails. So most email programs will have a way of encrypting a message. If it doesn't, then you can get an add-on software program that will encrypt it for you. So some software you can just put, for instance, in the subject line, you can put the word encrypt and then whatever the subject is, and then the software will automatically electronically encrypt that to help protect data, so that if someone intercepts that email as it's going through the ether, then they will not easily be able to read that email and to see what is inside of it. You will want to back up any sensitive data to a secure outside source. So you can do a couple of things. You can have an outside, like on the cloud, backup, which is great to have that. You may also have, instead of that, or in addition to that, a hard copy backup, like on external hard drive that you connect to your computer. You back everything up and then disconnect it from your computer. Because if it stays connected to your computer and somebody's able to hack in to your system, anything that's connected to your computer, they're going to have access to. So if you back something up onto your hard drive, make sure you disconnect it afterwards so that the hackers cannot get into that. And then whenever you're doing a return, make a final review of the return information, especially banking information, before filing. So you're always going to want to do this. This goes back to not relying on the software and not relying on yourself as the person doing the data entry or whoever in your office did the data entry. You always want to go back over the tax return, make sure it looks the way you would expect it to look and that all the numbers tie back to the original documents. And specifically here, we're concerned about the banking information. So if you are having money going into or out of a bank account, then you're going to be putting the routing number and the bank account number into the software. You want to make sure that those numbers are accurate so that you're not sending a refund, for example, into somebody else's bank account. If you get rid of a computer and you're getting a new computer, you want to either wipe the hard drive clean of the old computer after transferring all of the data, or you want to destroy that old computer hard drive and any printers that may have data on them so that somebody can't just root through the garbage or the recycling center or wherever you take that old computer or old printer and get that information. You always want to limit access to taxpayer data to individuals who need to know. So if there's an administrative person, for instance, in your office that doesn't need the taxpayer data, they should not have access to that data. You can actually check with the IRS online your PTIN account and your EFIN account. We'll talk about an EFIN here. It's an electronic filing identification number. We'll talk about that in a little while. But you can check on those and what returns have been filed under your PTIN and under your EFIN to make sure that those numbers have not been compromised and there's not someone out there filing returns under your number. So you can go to the IRS website and check to make sure that it's not being used by someone else. And if you had a power of attorney with a client and they're no longer a client, then you can withdraw from those POAs. And this way, you will not have access to their data anymore, and they can't accuse you of having access or of doing something with the IRS that you weren't supposed to do. So if they're not a client anymore, go ahead and withdraw from those power of attorneys. Remember, you just take a copy of that 2848, you write withdraw on the front page, you sign it, and you send that to the IRS in order to withdraw. If you do have a data breach, which of course in this day and age can happen, you see about it in the news all the time. You've got large companies with all of the data security steps and software and everything in place. They've got people whose job it is to protect the data, and sometimes they still have a breach. So if you have a breach, you need to report it immediately to the IRS stakeholder liaison. You should probably remember that for the exam. You report it. It's called the IRS Stakeholder Liaison. They have these around the country. There are several of these. You will report it to them. And then possibly you need to report it to law enforcement as well. It could be local law enforcement, it could be federal law enforcement. But you don't want to keep it under your hat. Not that you're going to broadcast it to the world, but you want to report it to the appropriate authorities so that they can look for who did it, for who stole it, and so they can help you to know what the best next steps are for changing your systems, for securing the data you do have, for notifying clients, etc., and so forth. Not a fun thing to go through, but if it happens, then you need to face it and take the steps that are necessary in order to remedy it as best that you can. If you have paper files and documents, those also need to be kept securely. They should be in locked rooms and or file cabinets. Those rooms or cabinets should be protected against damage such as by fire or floods. And when you are disposing of documents, you should do so by shredding it. So you can get yourself a shredder, a good cross-cut shredder, so there's no way anybody could put those documents together. Or if you have a lot of documents that you're dealing with, you can actually hire a service. You can put everything into a secure bin, and then the service will come by periodically and they will take those documents and shred them for you. So now let's talk about electronic filing. You, as a tax preparer, if you're working for yourself, you can apply to be an e-file provider, and you will probably want to do this if you're going to e-file tax returns, which you are. If you're filing tax returns, you're going to be e-filing tax returns. And so you are going to want to apply to become an e-file provider. In order to do so, the first thing you have to do is have an e-services account. That's at irs.gov/e-services. And then you fill out the online application. And the one you're going to choose is Electronic Return Originator. So ERO, you're going to want to know this for the exam. You're going to see this a lot. ERO, Electronic Return Originator. In order to do that, you're going to have to pass a suitability check. Could include a credit check, tax compliance check, criminal background check, and a check for any prior non-compliance with e-file requirements. This can take up to 45 days. Once you are accepted, you will be issued an EFIN that we talked about, the electronic filing identification number. Usually you will get one EFIN per location of your firm. So if you've got just one location, you'll get one EFIN. If you've got multiple locations, each location will have a separate EFIN. That way the IRS can track where that return is coming from, where it was filed from. There are mandates for e-filing. So any tax preparer who reasonably expects to file 11 or more tax returns in a calendar year is required to e-file. In other words, you're not allowed to file on paper unless you've got special circumstances, and then you can apply to the IRS to waive that rule. You file Form 8944 in order to request that waiver. If you do get that waiver, then every return that you file on paper has to include a Form 8948 preparer explanation for not filing electronically. So you have to first get permission to not file electronically, and then with every paper return, you are going to submit this form that says, hey, I've got permission to not file electronically. That's why I am not doing so. So that when the IRS looks at it, they know not to go back and go after you and penalize you for not e-filing. For information returns, we talked about this previously, but when you are filing W-2s, 1099s, etc., if you are going to file 10 or more of those, then you must file electronically. And that is a new rule for 2023. So look for that on the 2024 exam for a question on that, because the old threshold used to be 250. So that's a big drop. A lot of taxpayers who used to not have to file electronically now do have to file electronically. And this is 10 or more in total. So you add up all your W-2s, all your 1099s, etc. So let's say you've got 2 W-2s and 8 1099s. That is a total of 10 information returns, so you must file those electronically. So now we'll talk about the ERO specifically being an electronic return originator. An ERO is an authorized IRS e-file provider, and as an ERO, you begin the process of electronic submission of a return to the IRS. So you are the one hitting the button that says submit this electronically. So you're going to be the first point of contact for most taxpayers who are filing a return using IRS e-file. You should only submit returns electronically for either tax returns that you prepared or that you collected from a client or from another provider, so another preparer. You can actually, as an ERO, submit returns for another preparer. But the point is here, from a security standpoint, you don't just take anything anybody walks in off the street and wants you to submit something, or anybody emails you something and says, hey, can you submit this for me? You don't do that. You're doing this for clients, or maybe if you've got some agreement with another provider who is not an ERO for some reason, and you know them and you've got an agreement with them and you trust them, then you might submit for them. But you want to make sure it's only people that you know and that are clients that you're dealing with, and that you're not doing this for people who might be out there committing some sort of fraud. And being an ERO is a separate and distinct function from being a tax preparer, even though you're probably going to be both. But technically, it is separate. That's why you might submit returns for another tax preparer who is not an ERO, because they are two separate functions. Now, in the real world, I have never submitted a return for anybody other than my own firm. Theoretically, though, it is possible, so you should know that for the exam. But when you're actually out there working, you're going to be submitting returns for taxpayers that you prepared their return. That's what you are going to be doing. But technically, it is a separate function, and so you need to know that. The ERO begins the electronic submission by doing one of the following: either electronically sending the return to what's called a transmitter that will then transmit the return to the IRS, by directly transmitting the return to the IRS, or providing a return to an intermediate service provider for processing prior to submission to the IRS. So these are the three things you want to know for the exam. These are the three entities you might be submitting that tax return to, is any of these three. In the real world, what you are going to be doing is you're going to have a tax software that is going to be set up to accept electronic returns. So you are going to submit the returns through your software, and the software provider is either going to be a transmitter or an ISP, intermediate service provider, or they're going to have a contract with a transmitter or an intermediate service provider, and then they are going to forward that return on to the Internal Revenue Service. And then they will get back to you to acknowledge that, yes, the return has in fact been filed and accepted by the IRS. As an ERO, you have a variety of responsibilities, and they include all of these things: timely filing whatever electronic returns you are supposed to file, submitting any required supporting paper documents to the IRS. We'll talk about that in a little while coming up. Providing copies of the return to the taxpayers, retaining records and making those records available to the IRS, accepting returns only from taxpayers and providers, reporting income derived from electronic filing activities, and protecting your EFIN. So you don't want to be letting people know what your EFIN is. You need to safeguard it, because there are fraudsters who would love to have your EFIN to file tax returns under your name and under your EFIN, and they would be fraudulent returns. And so you don't want any part of that. So keep your EFIN protected and keep it private. If you sell your firm, the buyer does not get your EFIN. They have to apply for their own EFIN. In order to e-file a return, the taxpayer has to agree to it, and they do so by signing this Form 8879. Also, because they're e-filing, of course, they're not signing a paper copy of the tax return. So in the old days, quote unquote, or even today, if you file on paper, then the taxpayer has to sign the tax return, right? There's that signature block where they sign under penalty of perjury. Well, for e-filing, they don't have that. So what do they do instead is they sign this Form 8879, which is their e-file signature authorization. And then you can see if you're filing an extension, then you use Form 8878 instead. And so this is the taxpayer's declaration that the return is correct. And it also gives you, as the ERO, the authorization to go ahead and electronically file the return. So let's have a look at the 8879. You are going to want to get a copy of this and look through it. It's a short form, short instructions, but go ahead and get it. You've got all the normal identifying information at the top. And then it's going to have some of the key numbers from the tax return are going to go on here. And again, your tax software is going to go ahead and fill these numbers in for you. But it does show adjusted gross income, total tax, total withholding, and then the amount either refunded or the amount that the taxpayer owes. And then we go down here to the PIN. So for every return, there's going to be a PIN that is generated. Either the taxpayer can select their own PIN, but usually they don't care. They're not going to do that. So your system will just generate a PIN. And so that will all be shown here. And the taxpayer, by signing this form, is authorizing you through the system to generate that electronic PIN for them. So then the taxpayer signs here. And if they are married, the spouse will sign and date down here. And you will keep copies of all of these signed returns, as we will discuss here in a little while. Paper document transmittal. Sometimes, even though you're electronically filing the tax return, there are some paper forms or documents that need to be filed on paper. They cannot be filed electronically. So when you have those, you're going to use this Form 8453 to indicate what you are submitting and to actually submit those paper documents. And the ones that you are allowed to use this form for are listed on the form itself, which we will look at here in a minute. You must submit this Form 8453 along with the attached documents within 3 business days after the IRS acknowledgement of acceptance of the e-filed return. So in other words, you're going to submit the return electronically. Once you get the acknowledgement back that that return has gone through, that the IRS has accepted it, then within 3 days, you need to put into the mail this Form 8453 and whatever documents that you are attaching it. If you need to submit a paper document with the return other than one that's listed on 8453, then you cannot e-file. You need to file that return on paper instead. So let's look at the 8453. Again, at the top is all of the normal identifying information. And then this is going to show you, just check the box of whatever it is that you are attaching. So a couple of examples you may recognize: the 2848 power of attorney. If you're submitting one of those, you would use this form. The Form 3115. So this is when you are applying to change your accounting method. That's the Form 3115. And then you can see the other types of forms that you can submit using this form. And then the 8453 itself, it actually says down here, do not sign this form. So you don't have to sign the 8453. The other forms that you're submitting likely will need to be signed. And again, if you are sending some other document in other than one of these forms, then you need to file that return on paper instead of electronically. When you e-file a return, I already talked about how you submit it, it goes through, and then you get an acknowledgement back that the IRS has accepted the return. Well, sometimes you don't get that acknowledgement because the return is rejected. So you need to know, how do you handle it if that return is rejected? So usually it's going to be rejected due to a mismatch in information. So the IRS already has some information, then you submit a return and there's a problem. There's a mismatch there, or something's already been submitted using that number. So for example, if you submit a return and the IRS doesn't recognize the Social Security number, or the date of birth doesn't match what they have on file. So the IRS cross-references their files with the Social Security Administration, which has, of course, everyone's Social Security number and date of birth on file. So if those records don't match, you could get a rejection. If a tax return has already been filed with that taxpayer's Social Security number, we've talked about that before. We'll talk about it more again, but this is usually as a result of fraud. But if somebody else has already submitted a return with that Social Security number, then you are going to get a rejection. They are not going to accept a second return. Similarly, if somebody has already taken a dependent. So if you claim a dependent on your tax return, you have to put their social security number on the return. Well, somebody's already claimed that social security number, then you're going to get a rejection. If there is an electronic signature mismatch, so one of the ways the IRS tries to make sure that the right person is filing the return is they will ask, what was your adjusted gross income last year? And you have to put that on there. So if you do that and it doesn't match, you could get a rejection. Or if you need a PIN number and you didn't put the PIN number in, or you put the wrong PIN number in, then that return will be rejected. And then also, if you have an employer identification number that does not match records, similar to how the social security number doesn't match, then you will get a rejection. So if you get one of these rejections, then you need to stop and figure out what's going on. And then you're going to want to contact the client and work with them to resolve it. So as we've discussed before, if somebody's already filed a return with the same social security number, then you're going to have to submit that return on paper along with requesting the PIN number saying, hey, my identity's been stolen, so I need a PIN number. If it is something like a dependent, then you're going to want to talk to that taxpayer, and it's likely maybe it's an ex-spouse or something like that. And you may have to end up filing that return on paper as well. If you look at it and you decide that, yes, my taxpayer really does deserve and qualify to have that person as a dependent on their return. So let's say it's a child and it's an issue between the parents, which is commonly what it's going to be. If you determine that, yes, your client is the one who should be taking that dependent, then again, you're probably then going to have to file a paper tax return and list that dependent. And then you probably want to attach a statement. You can just do a free form statement to the return saying that you are taking this dependent and they qualify as your dependent. And then you can let the IRS figure it out from there. And if you got one of these other issues, then you, again, the client may have to go to the Social Security Administration and submit a name change or something like that. You're just going to have to work with the situation as it is and figure out the best way to resolve it. So let's talk some more about the identity protection PIN that we have discussed previously. This is a 6-digit number that prevents someone else from filing a tax return using your Social Security number. If you are a confirmed victim of tax-related identity theft, then the IRS will automatically send you a new PIN every year. They'll send it to you in the mail. But anyone can apply for a PIN, and the IRS is now encouraging taxpayers to proactively request a PIN in order to prevent tax-related identity theft. So anybody who's worried about this can go ahead and request a PIN. The IRS will send it to them, and then you can use it. And you can apply for this online or by mail using the form 15227. But either way, you are going to have to verify your identity when you apply. Record keeping requirements for an ERO. Remember, an ERO is technically separate from being a preparer. So as a preparer, you have record retention requirements that we already talked about. As an ERO, there are separate record retention requirements. Obviously, you're going to want to do the one that requires you to keep the documents the longest, which is usually going to be the preparer. But for the exam, you need to know the ERO record retention requirements. So you must keep copy of all of these things until the end of the calendar year in which the return was filed. So it's a 2023 return filed in 2024. You need to keep all of these things through the end of 2024. Copies of W-2s, 1099s, etc. Copy of the Form 8453, along with whatever you transmitted with the 8453. The acknowledgement files for the IRS accepted returns. A complete copy of the electronic return that can easily be converted into an electronic transmission to the IRS. So if they ask you, hey, I know you submitted that once, but we need another electronic copy, that you can easily do that. And then a copy of your signed IRS e-file consent to disclosure in either of these circumstances that are listed on the slide. If the taxpayer enters their own PIN number, or if you've got a 4868 without electronic funds withdrawal. Again, you will notice that these requirements are shorter than the requirements for you as a preparer. So, what you are going to want to do in your own practice is keep all of these things for as long as the statute of limitations is open. So, in other words, at least for 3 years from when the return was filed. But for the exam, you need to know that these are the requirements specifically for an ERO. For the forms 8878 and 8879, that's the signature of the taxpayer acknowledging that everything is accurate on the return and allowing you to e-file the return. Those things must be kept for that statute of limitations for 3 years from the due date of the return or the date the IRS received it, whichever is later. E-file advertising standards. So we talked about advertising standards in video 1 of part 3, but this is going to be particular to e-filing. IRS e-file is a brand name. You as an ERO are an authorized e-file provider, and you can represent yourself as such. Of course, you have to follow all the advertising and solicitation provisions of Circular 230, so you can't do anything that's false or deceptive. If you are offering a refund anticipation loan, this is where the taxpayer can, in effect, get their refund right away as soon as they file their return. What they're actually doing is getting a loan from a bank. And you may be able to offer this service to your clients. And usually through your tax software, you can set this up. But if you are offering these, the advertising that you do has to be clear and easily readable and must state that the taxpayer is borrowing from a financial institution against an anticipated refund. So they're going to have to sign documents acknowledging that they are borrowing from a bank, and that it is against an anticipated refund. And if for some reason that refund is not actually due, then they're going to have to pay the money back. It is a loan. So if you are advertising that program, you have to be clear about what that program is all about. You can use, as we discussed before, the IRS e-file logo, but you cannot combine it with the IRS eagle, the word federal, or any words or symbols that imply a special relationship with the IRS. In other words, you can't pretend that you are somehow the IRS or that you are an official employee of the IRS or anything like that. And you cannot place other text on or near that logo, and it has to meet other standards as well. Compliance requirements as an ERO. So the IRS is going to monitor you as an ERO and to make sure you are in compliance with all requirements. They will perform suitability checks on the firm and all of its principals, both upon admission to the e-file program, that's when you first apply, and at regular intervals afterwards. So if you fail a check, whether it's initially or it might be a pass initially, but later on, you have some issue come up and they do a check on you, then they could revoke your ERO status. And they monitor you by reviewing IRS records, and they can actually visit your office and observe and see how things are going in your office. This monitoring may include all of these things that are listed here. They're going to review the quality of your submission for rejects and other defects. So you are submitting returns electronically, and they know how many returns you submitted, how many of those are rejected. And if you get outside the norms, like you've got more rejected than normal, then they might be thinking that there's a quality issue, and then they might want to have a closer look. They will check to your adherence to getting signatures. So you always want to get that 8879 signed, and then you're going to keep copies of those. They can look at your advertising material. They can examine your records. They can observe your office and all of your security procedures. They can do those compliance checks both on your firm and on you and any other individuals who are principals in the firm. And then they also will monitor your compliance with all tax preparer regulations, especially the due diligence requirements that we talked about for all of those various types of credits and for head of household status, where you have to fill out the separate form. You've got to go through that checklist. You have to make sure that the client, the taxpayer, actually qualifies for those credits. Revocation. So the IRS can revoke your status as an ERO. And specifically, what we're talking about here is if the firm or you or any principal of the firm has a federal court order that says you're no longer allowed to file returns, or you're prohibited by any federal or state legal action from submitting returns, then they will revoke your ERO. And if they revoke that, you are not entitled to any type of administrative review. You can't go to appeals or anything else. You just lose it. End of story. Now, if that injunction or other legal action expires or is reversed, then at that time, you may be able to reapply. Sanctions. If an ERO violates any e-file requirements, that could result in either a warning or a sanctioning. So depending on how serious it is, there could be a written reprimand, there could be a suspension, or an expulsion from the program altogether. The seriousness of the violation depends on whether it is a level 1, level 2, or level 3 infraction. So you will want to know this for the exam. These are the level 1, 2, and 3 infractions. Level 1 infraction is a minor violation with little or no adverse impact on the quality of electronically filed returns. And usually, if you just have a level 1 infraction, it will result in a written warning. A level 2 infraction are more serious violations that have an adverse impact, or it could be repeated level 1 infractions after you've gotten a warning. So they've warned you, you keep doing it, that can rise to the level of level 2. A level 2 infraction will usually result in a 1 to 2 year suspension. So you won't be able to electronically file returns for 1 to 2 years if you are found to have committed a level 2 infraction. A level 3 infraction is for serious violations, and it can include continued level 2 infractions after you've already been cited for those. For very serious infractions, such as identity theft, fraud, or criminal misconduct, you can be immediately kicked out of the program and not have the opportunity to participate in the future. If an ERO is sanctioned, they can appeal it. So the first thing they can do is they can request an administrative review within the office that sanctioned them, unless it's a written warning. If it's just a written warning, then you just accept it. It is what it is. But if you get suspended or you get expelled, then you can request an administrative review. If that review upholds the sanction, then the ERO can appeal to the IRS's Office of Appeals. Once an individual is expelled, they may be able to reapply after 5 years, but there are some expulsions that you're not going to be eligible. So again, identity theft, fraud, criminal misconduct, they're not going to let you reapply after 5 years. But if it was for something else, you may be able to reapply again after 5 years. And that, my friends, is the end of video 4, the end of part 3, and the end of the entire course. Congratulations on making it through the course, and best of luck to you on the exams. Go back and watch any of the videos where you need a refresher, study the slides, and come back and comment on any of the videos, and let me know how you did. Let me know that you passed. I would love to celebrate your success. And stay tuned to this YouTube channel. This is not the end of the road. There will be ongoing education and updates on this channel to help you throughout your career. So thanks again for joining me. Best wishes to you on a successful exam and a successful tax career.